Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are running through discussing when the interest rates will be coming back down. Don't we all want to know? So this is my thoughts of when I believe they'll be coming down. To kick it off, the cash rate is currently sitting at 4.35%. So based off historical averages, it is still relatively average. The 20 or 30 year average for the cash rate is around 5%. So based off long-term trends, it is still relatively on average. So I don't believe they're going to be coming down in the near future. And I'll show you why I believe that in the future slides, and potentially may even have another few notches heading up. So based on where we're at, I can probably see them staying here, but time will tell. So it all links back to inflation. So inflation has been elevated in recent years, coming out of COVID, where they dropped interest rates, printed a lot of money that set off inflation. They're now clawing back that money by raising the cash rate, by restricting lending from a borrowing perspective, but then also charging more interest on the lent money to rein in those funds that was splurged through recent years. But inflation's coming back down. The monthly indicator for September is back down to 2.1%, so that is good. And the average consumer price index, so the inflation rate is sitting at 2.8%. So the RBA's target is to have the inflation rate sitting consistently within the band, being between 2 to 3%. So 2.5%. They want it not just to touch into the band. They want to maintain consistently like what we saw between the period of 2015 to 2019. They don't want it below 1%. Anything below or negative is disinflation. So that's also not great for the economy and not great for growth and production. So they want to see inflation consistently stabilize within the band at around that 2 to 2.5%. And I don't see them cutting rates yet, and definitely not this year, and probably not until another year or two, because if they cut now, it would be inflationary and it may kick off inflation again. So they want to see consistently held inflation within that 2 to 3% band to build confidence that they are not going to set off inflation again when they drop rates and take the restricted cash rate lower. So the RBA, these are some key notes from their latest RBA meeting. Looking ahead, headline inflation is forecast to remain temporarily within the 2 to 3% target range until September quarter 2025, so to the back end of next year, 2025, when scheduled the end of the energy rebates would see it pick up. Inflation was not expected to return sustainably within the target band until 2026. So that's what Michelle Bullock and the board believe, that they're not going to see the inflation rate consistently held within that 2 to 2.5% range until 2026, as the level of aggregate demand and aggregate supply are not yet equalized. So there's still more demand in the economy than there is supply. In order to bring that back down, they need to maintain a more restrictive cash rate until inflation is more stabilized. So basically, the RBA doesn't see the inflation rate being maintained consistently until 2026. So they haven't yet put a finger on when, but I believe based off the 18-year land cycle, which we'll get to in the future slides, the 18-year land cycle will top out in Q2, so around April 2026 in the United States. Australia typically trails 6 to 12 months behind the US, so it won't be until probably September, October 2026 where we'll see the market top out. At that point, I believe rates may start to come down. So moving on, again, we can see we like to keep a good an eye on the US inflation rate. They are consistently now, I guess, within the 2 to 3 band. However, the Fed, the Federal Reserve in the US, don't have a target or a band between 2 to 3%. They've got a target of 2%. So they want to see their inflation rate below 2%. So that's an even lower level than what Australia has as a target. So they're already down to around 2% inflation, but they want to see it consistently below 2%, like what was seen between 2016 to 2020. So the US has begun cutting their cash rate. However, they have come off a higher level. They topped out around 5.5%, and they're back to 4.75%. They're still above Australia's cash rate of 4.35%. So I wouldn't get too excited yet, but it is a good indicator that the cash rates are coming down in the coming years. Again, we've now got a property tycoon entering the White House as of January. Trump, he's going to do everything in his vested interest. He's a property guy, has high-rise apartment buildings around the world, hotels, golf courses. So he's a real estate guy. He likes low interest rates, obviously, because it makes the properties that he holds cash flow better. It makes borrowing easier, makes financing deals easier, financing developments easier, and also has a knock-on effect to a booming economy, which now he's a politician. He wants a booming economy because that is a KPI for politicians. They want booming economies. They don't want a recession. So having low rates stimulates the economy. So he will do everything in his interest to get rates lower. So his policies, key policies that he's been talking about in the recent months leading up to his win with the election, he's going to be drilling oil. So the US has pretty much the most market share in terms of crude oil around the world, more than Saudi Arabia, more than Russia. He is going to be drilling, drill baby drill, so he says, to flood the market with oil to bring oil price back down to $40 a barrel. There's a number of reasons why he is doing that. I guess we're talking about the cash rate and inflation today, but ultimately he wants to bring down energy costs and become energy dominant around the world. Once he brings down the oil price and brings down energy costs, energy costs and oil goes into everything such as cars, so fuel price, transport costs of planes, train, transport of ships of goods around the world. So once oil price comes down and energy costs come down, so will inflation, because it is passed on to the end consumer when the cost of oil is higher. So once oil is lower, you can imagine going back to the petrol station and paying $1.20 a litre. That'd be nice, rather than $2. Everyone would have more disposable income. Lower inflation down ultimately will allow him to then cut interest rates to lower levels, because he wants interest rates back down to the 2 to 3% mark. So in order to allow him to do that, he is going to be drilling to bring oil and energy price down and ultimately to reduce inflation. So then it will allow him to then drop the federal funds rate. So that's great, because then that will then spur on Australia. Typically trails 6 to 12 months. Once inflation is well between the band, that's when the cash rate will be coming down. So he will also, Trump that is, will also look to have more oversight over the Fed, over Jerome Powell. He's even talking about whether or not it is legal for him to even sack Jerome Powell and put someone else in charge of the Federal Reserve that would be more inclined to drop the cash rate. So cutting the federal funds rate back down to the 2 to 3 band. And yeah, as I said before, Australia typically trails 6 to 12 months behind. So the light is definitely at the end of the tunnel for the cash rate in America, and time will tell. But I suspect, like what we saw back in his first term between 2016 to 2020, inflation was between 1.8% to 2%, and the cash rate was well below the 2 to 3% mark. So I can expect that to be a pattern that history doesn't repeat exactly, but I can guarantee you it will rhyme, and at some point we will see the cash rate back down again. So I think to better understand how the cash rate will inevitably come down is the 18-year land cycle. We are now in the last 2 years of the land boom. This is called the winner's curse. A few more years of booming markets. However, not every market's booming, such as Sydney and Melbourne. They're more subdued, but they're primed for the next growth cycle. But Brisbane, Perth, Adelaide, and the regions have had significant growth. Inflation's higher. Once the market tops out in Q2 2026 or mid 26 in the States, Australia will trail 6 to 12 months. By the end of 2026, even based off the commentary coming out of the RBA, where they're expecting inflation to come back down consistently within the band, that is when they'll have confidence that, okay, inflation's now stable, energy costs around the world will be lower because the states will be pumping oil like never seen before, and inflation will be down, rates will more or less begin to come down, I believe, in late 2026. And by 2027, that's when the market will turn through the next major land-driven downturn, like what we saw in 2008 and 9 GFC, or the 91 recession we had to have. So once the market turns, it won't take much for the equilibrium to shift. The fundamentals will change from being a significant demand in the economy to subdued growth downturn. That's when you'll see not just the Fed and not just the RBA, but most central banks around the world will be dropping rates back down to near zero before you know it. So come 27, and definitely by 2028, rates will be back down to near zero again. So the light is definitely at the end of the tunnel. And I think, personally, I think rates are going to stay where they are, if not maybe a couple of notches up between now and 26 in Australia. In the States, I guess Trump wants to try and get the cash rate down. He may well do that, but that may kick off inflation again. And if that kicks off inflation, then potentially the rates may need to go up in Australia. So I don't see rates coming down between now and the end of 2026. I believe they'll stay here. If not, they'll just stay at 4.35%, maybe notch up to 4.5%, maybe 4.8%, maybe top out 5%. But come end of 26, that's when we'll hit the peak, and we'll be back down in 2027, 2028, back down to near zero before you know it. So I think to overlay this to give you a little bit more guidance of history. This is the cash rate where we are today, 4.35%. And based off the 18-year land cycle, we are in a similar point of the cycle in 2005. So in 2005, 5.5% cash rate. And between 2005 through the last few years lead up to the peak in 2007, 2008, cash rate got to 7.25% before it topped out and then got dropped. Now, I'm not saying it's going to get back up to 7.25% because there's a lot more debt in the system. It's a different economy. But however, history doesn't repeat, but it definitely rhymes. So I can tell you now, I believe the cash rate will maintain at this level. And as I said before, I wouldn't be surprised if we see another rate rise or two in 2025 and early 26. But by the end of 2026, it'll top out probably around the 5 to 5.5 max percent at the cash rate. So at the banks, 7-8%. And then they'll be dropped back down to near zero again before you know it. So I'm preparing for rates to stay where they are and even higher in the next year and a half to 2 years. So I'm cashing up. I'm looking even to offload assets out of markets that have had a great run to cash up, pay down debt, not be over leveraged, because over the next couple of years, yes, the markets will be booming. However, you need to be able to stay in the game for the long term and not be too over leveraged and sailing by the seat of your pants, because you need to be able to get through the next 2 years with higher rates before we come through the light at the end of the tunnel. Come 27, rates will be very low again, 28, rock bottom, and that's when we'll be going through the next land-driven downturn, which will be the best opportunity in a lifetime. That's when the deals will be out. That's when the best time will be to snatch up the bargains with very low rates. But come 27, 28, I can guarantee you most people will be running for the hills, scared that the whole world's going to collapse and the world's going to fall in. But that is the best time to buy in the next 2 or 3 years. So we're preparing now, buying up in Sydney and Melbourne, because once the rates drop and they'll print money come 2027, 28, rates will drop, they'll print money, there'll be a rush to affordable accommodation. So the top end real estate, so high end apartments, new and off the plan, prestige real estate will get slaughtered 20, 30, 40% from the peak. Commercial will get hit 60, 70% based off history. But the affordable stuff that we buy between the 250 to 350 mark, that's affordable range. That will have more demand because people will be looking for more affordable. And based off my experience during 2020, when they drop interest rates, print money, it gets soaked up eventually in real estate values. And when there's a shift in demand from the more expensive real estate to more affordable, the demand for the bottom end rises. And that's even when the market's going south, the more affordable end of the market continues to grow and gain capital gains throughout the next downturn. So hold on tight for now. But yes, it's not over yet, and it's not time to be over leveraged. And don't expect a rate cut this year or in 2025. And hold on until late 26, early 27. By early 27, and in 2027 and 2028, we'll have low rates again, I believe. So another way I like to look at it based off history, we are now here, 4.35% cash rate. Inflation's remained high. It's based off inflation when the cash rate will come down. Inflation's down to 2.8%. So if we go back in time to see what happened in 2005 and 2006, where we are in the similar point of the cycle, based off the 18-year land cycle, 2005, we saw inflation, the cash rate continue from about 5.5% up to 7.25 in 2008. And inflation's the key to keep an eye on. So even though it's coming down to 2.8%, I wouldn't be surprised that inflation may tick up in the next year or two. In the last 2 years of the land boom, as what we saw in 2005, inflation was 2.8%, then rose in 2006 to 4%. So Q3 2006, 4% inflation. So potentially that could come back, higher inflation next year. And then there was a dip down in 2007, 2%, but then there was a rebound up to, it's a bit tricky, this graph, because I'm comparing them. So Q1 2008, 4.3% inflation, and it peaked at 5% inflation in 2008, May, June 2008, 5% inflation, and then the market finally turned through the land-driven downturn in 2008-9. Inflation and rates came back down. So that is what I'm expecting to happen over the next year and a half, 2 years. Yes, inflation's coming down, but I won't be surprised that it's coming down now and then might tick up next year and the year after. But by 27, 28, that is when the market will be going through the next land-driven downturn based off history, based off the 18-year land cycle, and we'll have low rates again. So hold tight for now. It is higher rates are here to stay, and we can see the light at the end of the tunnel, but don't expect a rate cut this year or next year, even though you may see commentators and even the banks may predicting a rate cut. It won't be until at least 2026, mid to late 26, and by 2027, that's when we'll be in a position where rates will be coming back down. So as always, this is by no means financial advice, as this is just general content in nature. This is by no means personal or general advice. I operate as a buyer's agent though. I use this information. I study the 18-year land cycle. I study what the RBA is doing, what's going on in the US, because ultimately I'm a property investor. I carry a lot of debt compared to the mainstream. So obviously I want to know where the cash rate's going so I can, one, prepare myself for higher rates, also get cashed up for when the deals come 27, 28 and onwards, because you want to be able to protect yourself over the next couple of years with higher rates, but then also be prepared for the bargains when they start to pop. But I'm also, in the meantime, still buying every 6 to 12 months. I like to buy a block of units, so a block of 3, block of 4, and I'm helping clients every day of the week get into the market because there's always a market prime for growth. Right now, we are focusing on Sydney and Melbourne as they will lead throughout the next land-driven downturn, as they are primed for growth for the next, moving forward for the next few years. So if you like this content, shoot me an email, reach out, happy to chat about your position, what you're up to, what your plans are moving forward, how I may be able to help you on your investment journey to get you to 10 properties within 10 years. 50 grand is all you need to start. Don't need to go out and buy the super fancy, flashy property to get ahead and build a substantial portfolio. 50 grand is all you need. Until next time, safe investing. Thanks for watching.